Often when I consult with clients, you hear arguments that as long as SARS gets to tax what they should be taxing, or as long as I only claim the deduction for an expense once, or even in the context of allowances, as long as we don't claim more allowances than we should be claiming in total, then surely we should be okay. There's no real loss to the fiscus. So this discussion all comes down to timing, really. So does timing matter? And that's what we'll be talking about in this episode of Tax Break, your podcast for South African tax professionals and practitioners. Before we get to the topic, as always, I would like to ask you to like the podcast, subscribe for it, and rate it on your favorite podcast platform if you like listening to it. If there's a person who you believe would enjoy the podcast or only a specific episode even, I want to invite you to also send the link to that person. I think that is still the best way to grow the listener base. Then there's two things I would like to remind you about. Firstly, the podcast companion app that I've developed. So if you go to tax.pvdz.co.za/app, so app, I've developed an app where you can, if you've got any ideas or suggestions for future episodes, you can type in your suggestion there. It will display on the app, and other listeners can give it a thumbs up if they like the idea. So I will then use that to see which ideas are popular and that I should be building future episodes about. I've also included something on my website, so tax.pvdz.co.za, where if you just scroll down past the top of the page, you'll see that there's a question box. So you can type in any scenario or any tax question that you've got. And using AI, the question box will then work through all of the content on my website. So all the articles, all the podcast episodes, and suggest to you what content would possibly be useful in considering your question. You are, of course, still welcome to send me an email if you don't want to use the app, or send your test your question via the website. My email address is in the show notes. So the case that we are talking about today is a tax court case. So as always, in the tax court, the taxpayers' names are not given in the judgment. So the taxpayer in this case is just identified as taxpayer EPP in a Joburg tax court case. The facts of the case are fairly straightforward. The taxpayer paid customs and excise on importing certain goods into South Africa. And in 2013, the taxpayer realized that the refund claims, to claim a refund of some of these customs and excise duties have expired. So the refund claims expired, and in its 2015 return, the taxpayer then claimed a deduction for the prescription of these refund claims. So the taxpayer argued that what it was claiming a deduction for was the loss that it suffered as a result of the clearing agent's failure to submit the necessary documentation in time to claim the refunds. So that's the 11A deduction according to the taxpayer. SARS argued that the taxpayer was actually conflating two things here. It was conflating the loss that it suffered, or the damage it suffered because it didn't claim the refunds in time, and the initial expenditure when it actually paid the customs and excise duties on importing the goods. And SARS's argument was that the taxpayer should have claimed the deduction when the real expenditure happened. So in other words, when the cost was incurred, so when the customs and excise duties were paid. So the court's view, in this case it was Judge Marley in the tax court. So the court agreed with SARS and confirmed that the Section 11A gives the taxpayer a deduction for expenditure incurred. Now, looking at the meaning of expenditure incurred, it refers to any voluntary disbursement of cash or resources, and a liability to make a payment in the course of your trading operations. So the court's view was that this outflow or disbursement of cash was the outflow when the taxpayer paid the customs and excise duties on the imports. The tax court referred to the sub-Nigel case to say, which held that you may only deduct your expenditure in the year in which the expense is incurred. So in other words, when it's either the earlier of paid or you've become obliged to incur that expense. The taxpayer also argued that there was some degree of conditionality around the expenditure. And the court's view there was to say that the conditionality actually didn't relate to the expenditure. The expenditure happened when the outflow happened when the goods were imported. The conditionality actually related to the refund. So the court also didn't rule in favor of the taxpayer there. The one aspect that if you take the view that the expenditure and therefore your deduction should have happened in year one when you incurred the customs and excise duties to acquire the goods, what would then also be related to that is that you presumably, if you were to then get a refund of those customs and excise duties, I would then expect the logical next step to be that in the year in which you get the refund, you must then account for a recoupment under Section 84A of the amount that you've now recovered through the refund, although the court didn't explicitly say that. So let's get back to our question. Does timing matter from an income tax perspective? So I think the case already illustrates to us that if you are looking at expenditure, you can only deduct the expenditure in the year in which it's incurred. And it is absolutely critical for you to make sure what is the expenditure. So in this case, it wasn't the loss of the refund. It was actually the outflow, or the court held that it was the outflow of the initial amounts. And then you need to also make sure that you correctly identify the year in which that outflow or the obligation arises, because that's the year in which the expenditure would be incurred. If we look at the income side of it, the definition of gross income, a taxpayer must include an amount in its gross income at the earlier of receipt or accrual. So it may be that an amount is accrued to you, and although you haven't received it yet, you would still be liable to pay tax on it. There would, of course, be some provisions like Section 24 that could assist you with some of the cash flow implications of this to the extent that you haven't received the amount yet. On the point of allowances, so that was the other aspect I touched on in the introduction. So generally, the tax law doesn't allow for catch-up allowances. So if you've missed an allowance in the year in which you were supposed to claim it, you can't just go and claim the allowance in the next year. You have to actually go back to the period in which you were supposed to claim that allowance and claim it in the correct period. There are, of course, exceptions to the rule about catch-up allowances. So if you look, for example, Section 24M specifically deals with what do you do with allowances on assets that you could have claimed, but at the point in time when you should have claimed it, the cost wasn't quantifiable yet. But that's an exception to the rule. That's not the rule. Right. And lastly, to perhaps conclude this episode, what are the risks if you get this timing wrong? If you claim the expense in the wrong year, you include your income in a year that's later than when it was supposed to be included. And the case illustrates quite well to us that your exposure is then understatement penalties, because for the specific year in which you claimed a deduction that you shouldn't have claimed, or that you didn't include the income that you should have included, although it was included in another year or it might have been deductible in another year, that doesn't, you're still exposed to understatement penalties for the specific year in which you got the timing wrong. So understatement penalties and interest would be your risk. So what's the take-home message? If we look at this case, and I think it's quite a simple one for this episode, timing does indeed matter. It matters from the perspective of expenses, as this case illustrated to us, but it also matters in the case of income or allowances. That's it for today's episode. I just want to remind you, as always, that nothing in this episode is intended to be tax advice or a replacement for fact-specific tax advice. Until next time, goodbye.